To the Cyclical Investors Club YouTube channel. As always, this is not investment advice, it's just for educational purposes. Today we're going to look at Campbell soup stock, which I wrote an article a few weeks ago. I was out of town for a while, so we're just catching up to this one now, but the price is pretty similar to what it was then, so everything here basically still stands. I'm going to try to get through this one pretty quickly because I think it's pretty straightforward. And there are a couple reasons that I come up with a strong sell rating for it. So I had written about it. I wrote about it a long time ago, and I always like to, and then I wrote an update a few months ago too. I always like to start my articles by reviewing any kind of coverage I've had before, as long as it's not like a different form of analysis or something. Because I usually don't tell like a big long story about the company. I like to look at the numbers first and see if those work. No matter how good the company is, if the numbers don't work, then I'm not buying it anyway. So I had a sell rating on it the last time I wrote about it a few months ago, and it was down a little bit. I mean, this short period of time, but you can see it's kind of underperformed. I would expect this trend to continue over the next several years probably, and I'll show you why here in the article. So one of the things that I'm doing with this new analysis is I'm trying to predict or estimate the stock returns about 4 years from now. So when you're using a fundamental based analysis, which this is on earnings, the history of earnings and what they're likely to do in the future, it takes a few years. Like over the short term, fundamentals don't really matter that much. Stocks trade on sentiment, macro, algorithm, stuff like that. But once you get into like 3 to 5 years or so, especially really beyond like 2 years, when then the fundamentals start to matter and it reflect in the stock price more and more. And then the longer you go in terms of years, price eventually always follows earnings for the most part. But the hard part is the farther you go in the future, the harder it is to predict earnings. So there's kind of this sweet spot at like 3 to 5 years where fundamentals matter more, but they're also a little bit more predictable in that range than they are like 15 years from now. And so that's one of the things that this 40-year time period is meant to kind of focus on. The other thing is that I'm going to have in here is kind of a generic mean reversion assumption. I give the data without that, and then after that I give it with it. I think that's really important, and another reason why I'm doing this in like this 4-year time chunk with a generic mean reversion, which is really what I mean is rather than base the mean reversion assumption on the past like 10 years when we had zero interest rates, I'm basing it on a longer term market kind of pricing average for when interest rates were more normal, because now interest rates are closer to what they've been over the longer history of the stock market. So to give a simple example, if a stock traded at a 20 PE the past 10 years, when interest rates were at zero, and the stock is down a little bit, the PE is lower, we wouldn't necessarily assume that it's going to trade back up to a 20 PE again. Maybe now, because interest rates are higher, we should expect it to trade at a 16 PE, right? So that's what this particular type of analysis is trying to take into account. And for certain stocks that really benefited from low interest rates, in terms of their valuations, this is going to be more conservative and I think probably more accurate, which is why I'm doing this now. If you looked at some of my old videos, I would just assume kind of whatever the trend had been the past 10 years or so in terms of PE ratio would probably be what it would revert to. And so I'm no longer doing that. I'm creating like a generic long-term market average PE and then translating it into the stock. Okay, I'll go over it again when we come down here. I hope that kind of gets through though. So the first thing I always check is earnings cyclicality historically, and I really focus on the recessions, And what I'm really looking for here is if there's any dips that are like more than like 50%. If earnings fluctuate more than that, they aren't really very useful for predicting future returns. And I use a different type of analysis for those type of stocks. But when we look at Campbell, they have a lot of negative earnings growth years, but they're all really small. I think if you combine these two together, like 15% is the most they've declined. Usually they're like single digits. So it's not cyclical at all, really. It just has a pretty narrow band of like where the earnings growth tends to be. So that means it's fine to use an analysis like this based on earnings. It makes it relatively easy to estimate a decent range, rather than if this was all like jaggedy. So since I'm using earnings per share to estimate earnings growth, I need to take into account their buybacks, because that will inflate the earnings per share over time. They've only bought back like 4% of the stock, so that's not like a very big adjustment, but I always like to get that in there. So here is what let me move myself over here. So I'm gonna try to get a big picture, maybe. There we go. Okay. So I zoomed this into the time frame that I'm going to use. Looks like 2014 to 2023, and I'm going to use the earnings that are estimated for July from 2023, which is $3 per share. Now, when we take everything into account during this time period, they've only grown earnings about 1.37% per year, which is really slow, especially when you consider the inflation that we've had now. Basically, this is below the rate of inflation. This right here is enough for me to not buy the stock at this point in time. The reason I buy stocks and not bonds is because I only buy high quality stocks. I define high quality by their ability to pass inflation on to their customers, okay? So if they can't pass it, which they have not been able to do over this time period anyway, a couple of these years inflation was probably about that amount, but when you consider the 5+% that we've had even on core inflation the past couple of years, I mean, this is basically all gone. So they haven't really grown in real terms. That would be enough for me to not buy the stock. But we're going to go through the analysis anyway. So even though they have a pretty slow growth rate, the PE ratio is 17.39, which translates to an earnings yield of 5.75%. The earnings yield is just the inverted PE ratio, so earnings over price. And that gives you this ratio. The way to think about this is if you bought the company for $100, that first year, if there wasn't any earnings growth, you would earn $5.75 on your $100. That company would earn that much. If you own the company, you could take that money and like go spend it, right? As the PE ratio gets lower, the earnings yield gets higher, so you earn more money. And that's why low PE ratios are, in their own right, are more attractive than higher PE ratios until earnings growth is taken into account, and then you have a time frame. I use a time frame of 10 years, which we'll see in a little bit, because it's reasonable enough that you can kind of predict that far. You're not predicting like 20 years. Who knows what's going to happen 20 years from now? Who could have predicted in 2003 we'd live in the society that we live in now? Basically nobody. So 10 years is short enough that you can kind of at least sort of have an idea what's going on in the future. It's long enough so that earnings actually would matter and build up over time. If you do have a fast earnings growth company, the longer time frame you look at it growing at that fast, the more attractive that it's going to be. So it's really important with fast growth companies to be aware that if you take 15 years of a fast growth company, they're going to look a lot cheaper than if you take a 10-year time period for a fast growth company, because that growth compounds and compounds. If it's like 20% a year, 15% a year, and it just looks better and better the longer you go out. So I cut it off at 10 years and use that as my kind of steady valuation time frame, which probably deserves its own video, but I'm not going to do that right now. So as I was talking earlier, the way I like to think about it is if you paid $100 for the business you would earn that 575 plus the growth rate the first year. So 583 is what you would earn the first year in your $100. And then what I do is I just add all those add how much you would get over time, accumulating that money if you own the business and you paid $100. So you start off with $100, you end with 162. What sort of earnings CAGR do you get? Well, if you pop that into a CAGR calculator, it's about 5%, 4.94% per year. It's about what you would earn if you own this business. And the historical trend continues for another 10 years. Now, what I'm going to do here is, even though I worked out this CAGR over a 10-year time period, I'm going to apply it to just 4 years because that's a little closer, and hopefully, I think there's some people that just, if they're retired or they're older or whatever, they don't think like 10 years and I think sometimes people's brains just shuts down. Well, if I'm 95 years old, I don't care what happens 10 years in the future. I want to know what happens in the next couple years. I think there's a lot of people that have that mentality, even though if they don't realize it. So this 4 year is it's close enough that people can wrap their brains around, no matter how kind of old they are, basically, or how, it's just visible. It's really hard to talk about far distant future things. So that's one of the reasons that I'm kind of using that time frame too. You'd earn about 21% if you own the business. If market sentiment for the stock stayed exactly the same as it is right now. So I compare that, assuming that the sentiment stays the same, to the S&P 500 and to cash, short-term treasuries, over 4 years. If everything stays the same, the S&P 500 probably turned 27, cash returned 17. It's more or less about the same, if nothing changes from here. So that can kind of explain why the price is where it is. The market's really, if you think nothing's going to change, then it's valued just kind of how you would expect it to be valued, basically, over a 4-year period. The problem is things have changed, and people are just now starting to realize it, I think. We have higher inflation, we have higher interest rates, and therefore there is a difference between getting a cash return compared to putting your money at risk in a stock, because the stock price can go down, the earnings can go down. In cash, the only thing you really have to worry about is inflation, and cash is paying about the same as inflation right now. So cash really is pretty risk-free over the short term, over the next couple of years, unless something kind of crazy happens. And then if something crazy happens to the downside, your cash doesn't lose value. So there's an added benefit and safety to just having cash. If you're naturally taking on more risk when you own a stock, especially one that isn't growing earnings faster than inflation. So what I do next is, this is where I assume, okay, what if interest rates and valuations just reverted to kind of an average longer term historical mean when we didn't have 0% interest rates? To me, that is 10% earnings growth and about an 18 PE is what this translates to. That's what about a 7% 10-year CAGR is. If you have a stock that's growing earnings 10% per year, which is pretty good, higher even than our current inflation, and it traded at 18 PE, which is actually what Campbell's is trading at now with a 1% growth rate, that's what I would consider kind of what the market typically does, right, in normal circumstances. So that's this next calculation. So, and with a 1.37% earnings growth rate that Campbell's has, you would expect a PE of about 11, and it has a PE of 17. So obviously the price needs to come down. The price will come down if the market ultimately decides that interest rates are going to stay kind of where they are now for a while, which is the assumption here. So if that happens, the stock price will fall, even if earnings grow a little bit, about 14%. S&P 500 actually rise about 14%, which is still not great. I mean, a couple percent a year basically is what we're looking at, 3% maybe a year. But it would, the S&P 500 would still outperform by like 27%. Cash would outperform by more than 30% or 3,000 basis points. So if things revert to old days, this is not looking so attractive. And my standard that I use here is if it's more than 2,500 basis points for both cash and S&P 500 that a stock is likely to underperform over 4 years, that gets a strong sell from me. Because you can just put your money in cash, you'll probably do better, and you're not really losing anything to inflation. You're probably not making anything, but you don't have any risk. So that's why I ended up with a strong sell rating. Generally speaking, I think between that and just the really slow historical earnings growth, you just likely aren't going to get good returns from Campbell, and you might as well hold cash or S&P 500, have a little bit more growth opportunity, maybe a mix of the two even, and you'll be better off. All right. If you want to have a link to the Cyclical Investors Club, I have a spreadsheet there where you can just type in your own growth rates and your own PE, and it will tell you this data in like seconds. For any stock that's kind of has steady earnings that you have that data for. And then I also have spreadsheets that have all that data for probably like 300 or 400 stocks that fit this category. So you can go through what I did in this article for any stocks that you have that you want to see. You can also always ask me to if you join there. It's $30 a month, and then you can contact me, message me. There's all kinds of cool stuff. There'll be a link, and you can go read about it if it's something you think you might benefit from. And then I have a couple more of these videos coming out very soon, so stay tuned. Later.